Stagflation is a word that, for one reason or another, is going to be used a lot more in the coming months. It simply means rising unemployment and slow economic growth occurring at the same time as persistently high inflation. None of these outcomes is ideal on its own, but when they all happen together, they create one of the worst economic scenarios imaginable, something that can, and has in the past, led to years of economic struggle or even the collapse of entire economic systems. The core issue is that the solutions for one problem tend to worsen the others. Low interest rates and increased money printing can stimulate market activity and make growth look strong temporarily, but more money flowing through the economy will inevitably worsen inflation. Conversely, raising interest rates and reducing the money supply can fight inflation, but doing so also creates intense economic hardship. The good news is that there are ways to untangle an economy from this situation, but they require careful, deliberate, long-term planning and some short-term sacrifices. And those sacrifices will likely be felt by almost everyone around the world. While stagflation is receiving a lot of attention in the United States right now, the US still has the advantage of exporting some of its inflation and stagnation abroad because the US dollar remains the world's default reserve currency. Meanwhile, many other countries may already be further along in this economic deterioration. So, why is stagflation such a big problem? Why is it emerging again now? And what kinds of sacrifices are usually needed to bring an economy out of this cycle? The central bank in the United States, and most central banks worldwide, has a dual mandate: maintain full employment and stable prices. Stagflation is particularly alarming for the Federal Reserve because it signals failure on both fronts at once. These goals also require nuance. Full employment does not mean zero unemployment. It means the lowest unemployment rate that is sustainable. If absolutely no one is seeking work, that can cause just as many issues as too many people chasing too few jobs. Similarly, stable prices does not mean prices never change. It means prices increase at a target rate of about 2% per year, a standard set by the Fed in 2012. The idea is that modest inflation encourages people to spend or invest rather than hoard cash, as money loses value slowly over time. These goals matter right now because even the Fed is quietly signaling that the economy is approaching serious problems with both inflation and unemployment. At first glance, the numbers may seem okay. Inflation is above the 2% target but down significantly from its pandemic peak, and unemployment is up from last year but still historically low. But the numbers themselves are becoming part of the problem. The US recently experienced its largest job number revision ever, revealing that nearly 1 million jobs had been overestimated. Official statistics are becoming less reliable as fewer businesses and individuals respond to the surveys those statistics rely on. Political pressure also influences data quality, and even if the data were flawless, it still would not paint a complete picture. Unemployment figures only count people actively looking for work. They do not capture declining labor force participation, which has been trending down for over 2 decades and includes people who have given up job searching entirely. They do not measure underemployment, where people work far below their skill level or rely on gig jobs. And they do not reflect people who technically qualify as employed by working only 1 hour per week, enough to improve the statistics, but not enough to support a decent life. Inflation is also difficult to measure accurately. Shrinkflation, product deterioration, and underestimation of housing costs mean that although the CPI shows prices up about 30% over 5 years, real household budgets are stretched far beyond that. And even if inflation returns to the 2% target now, that does not undo the damage from years of excessively high inflation. None of these issues are new, so why the sudden concern about stagflation? One reason is that data is only now catching up with reality. The massive jobs revision suggests employment levels may be weaker than they appear. The rise of underemployment and gig work masks the true economic situation. Economic growth is increasingly concentrated in a narrow set of industries. US GDP growth has looked strong, but it has been driven by heavy government spending, large investments in AI, and consumer spending, all of which carry significant risks. Government spending depends heavily on debt, which has been growing for 2 decades and is now facing serious constraints. New fiscal policies have reduced taxes significantly while maintaining spending levels, shifting funds away from social programs and toward areas like defense and border security. While the U.S. can print its own currency, that does not guarantee people will continue to value it. Taxes create demand for a currency. People must earn that currency to pay taxes or face legal consequences. Reducing taxes naturally reduces demand for the currency, and lower demand means lower value. If investors believe more dollars will be printed in the future, they will demand higher interest rates to compensate for the declining value, or else invest in alternative assets. This is already happening as major institutions increase their holdings of alternative currencies and gold. As borrowing costs rise, government budgets become strained, often leading to austerity, sharp spending cuts, and tax increases to control debt. This causes slowed or negative growth and higher unemployment. The U.S. has avoided these outcomes longer than most because the world relies on the dollar for trade, but other countries are now reconsidering this reliance. Stagflation is often blamed on central banks since they control employment and price stability. But in reality, it requires coordination between government fiscal policy and central bank monetary policy. Ideally, these two systems work together like synchronized hands playing a fine instrument. But currently, the Fed is attempting to manage inflation by tightening monetary policy while government fiscal actions push in the opposite direction. Inconsistent trade negotiations have disrupted supply chains, raising prices due to supply shortages while also creating long-term uncertainty. Tax cuts for the highest-income households amplify consumption among a small group that already accounts for half of U.S. consumer spending. While this group benefits from rising asset prices when interest rates fall, the rest of the population struggles with high living costs and limited wage growth. This imbalance makes the Fed's policy tools increasingly ineffective. As wealth inequality widens, the same policy change affects different groups in opposing ways. Lower interest rates boost asset prices for the wealthy, but worsen inflation for everyone else. Higher interest rates curb inflation but cause job losses and slow growth, disproportionately harming lower-income households. All of this deepens the challenges of managing stagflation and increases the risk that policy decisions will benefit one segment of society at the expense of others. The further these groups diverge, the harder it becomes to steer the overall economy. Subscribe, like, and share the video.